Welcome to the BullCast podcast. I'm Katie Pickler, and with me today is Court Winsett.
Hello.
And Cameron Spann.
I'm feeling a little sentimental today.
Why is that?
This is our last episode in the 200s.
That's crazy.
Well,
That is crazy. And what an episode to have. Let's talk about some gains, not the gains in the gym.
Gains.
We're working on our gains in the
I've
gym.
been gaining weight lately, so there is that. But
We're talking about capital gains. Love them, hate them, understand them.
what do you know about
What do you
them?
know?
I don't know.
So why do capital gains get so much attention? This is, again, a jargony term. You're like, oh, the capital gains, the capital gains. But do you understand what it means? Do you really understand it? Do you understand what all can have capital gains and what can't and how it affects you?
I, for one, would like to learn more about them. So this is a great episode.
Yeah, because it's, people are looking at capital gains. You don't actually owe capital gains taxes until you sell. But when you sell, it can make a big difference with those capital gains. So I feel like we're going to say capital gains like 999 times in this episode.
Maybe
Try not to.
We'll try not to. Yeah, obviously with capital gains, one of the key elements of capital gains tax is the timing. Is it a long-term cap gain or a short-term capital gain? So we'll get into that too.
Yeah,
Sure.
we'll explain exactly what it is, what creates it, why you need to understand it, how it impacts you.
But first,
The list.
this is one of the few things that we started off doing at the very beginning, and we haven't dropped it yet.
It's our shtick.
Yeah.
And I was looking at this list because I first saw this outline. I was like, oh, this is going to be a snoozer. Like, I agree, capital gains are something that people really need to understand, but how are you going to spice this up? How are you going to make it fun? And then I was reading through this list, and I really, really like this list because it does help compare the thought process behind a capital gain. So let's start it off. Marty McFly.
Okay.
Back to the Future. I know Marty McFly.
Well-
I personally just rode on a Mardi Gras float with Marty McFly. That would be the actor who is playing Marty McFly on this touring Back to the Future cast. His name is Lucas, or what I like to call him Luke. But no, Marty McFly, if you have not seen Back to the Future,
There are three.
three of them. Okay. So Marty there's a time machine. It's the DeLorean, a whole big thing. I'm not giving away spoilers, but Marty does the right things, but only succeeds when he hits the timing exactly right. A few seconds too late or too early, and the whole plan falls apart. So timing is very, very important in Marty McFly's world.
Yes.
Very important.
I'll keep this very quick. But
Okay.
did you know Marty McFly, Michael J. Fox in the movie, he was replaced, like he was the new Marty after they had begun filming.
They
And
had
to save
filmed-
cost, they didn't like the main actor, and so they were filming like the back of his head, these kind of things, to where they could easily get a new actor in there to replace him. So there was a lot of behind the scenes work to get the main character ousted, to get that actor out, and a new one in, and Michael J. Fox.
Yes, the
Fit the bill.
original actor was Eric Stoltz.
Thank you.
Eric
Thank you.
Stoltz.
What does he do now?
He's an actor.
Oh,
I mean,
is
he's
he?
been in other things,
Okay.
and I don't think he has ever made it as big as Michael J. Fox ended up making it. Probably, at least in part, off of this movie.
Yeah.
But he did do a lot of other work.
Apparently, he was very cocky, and he didn't get along with the director, and so behind the scenes, the director was talking to the studio, we need a new actor.
Yeah.
Okay.
So next,
So not very good timing for him.
yeah. But speaking of good timing or bad timing, number 2 on the list is Ross saying Rachel's name. For those of you who are not familiar with the 10-season-long TV show Friends, you may not be familiar with when Ross said Rachel's name, and it was poor timing. But he did it right in the middle of his wedding. And unfortunately, he was not getting married to Rachel at this particular wedding. So saying, I, Ross, take you, Rachel, to, I think her name was Emily, at his wedding to Emily didn't take that too well. And they ended up not
Yeah.
having a successful
I don't
marriage.
blame Emily.
Yeah.
Not at all.
So timing was obviously poor on that one. He chose poorly.
A wizard is never late, nor is he early. He arrives precisely when he means to. That would be Gandalf the Grey from The Lord of the Rings. Yes.
Very good. Okay, Tom Brady. Leaving New England for Tampa Bay. Brady didn't leave New England at the peak, but he left at the right time for his goals. The results, another Super Bowl win.
I thought you were going to say Brady didn't leave New England. New England left.
That's what I was thinking when I read that, of like, this is kind of like the actor for Marty, he got ousted out of that.
Yeah. I have no opinions on Brady. I don't really, or I didn't, I wasn't particularly fond of the Patriots dynasty. That's because a lot of sports fans have their own dynasty that they tend to root for. And in football alone, I've got two that I would root for over the Patriots. So, but I'm not sure if timing was perfect on his exit, but certainly he did not suffer from leaving when he left because he went on
capitalized on the opportunity.
Yeah.
So, I mean, sometimes your timing may not be the best, but what you do next can then make a difference
100%.
In your overall.
Yeah. So I think baseball fans, and I'm not a baseball fan, I'm not a huge baseball fan, but even I am familiar with the story of Babe Ruth being traded to the Yankees. That is potentially the worst timing for the Boston Red Sox ever because they traded Babe Ruth to the Yankees and they didn't just lose a great player. They lost him or sold him or traded him at the absolute worst time. The Yankees basically started their dynasty right after receiving Babe Ruth. And famously, the Boston Red Sox did not win a World Series for, a century after they traded him away. It was known as the Curse of the Bambino. So, clearly I would put that in the bad timing category.
That's some bad timing for sure. And
That's the list.
what are capital gains? Okay, you ready for your education, Cameron?
I was born ready for this. Teach me.
A capital gain is the profit you make when you sell something for more than you paid for it. Oh, okay.
Wow, that makes
Fancy way of saying I, bought this
Diet Coke stock.
I'm looking at your Diet Coke can.
Okay.
I don't know. I'm using
I'm
an
thinking
example.
Girl Scouts here. They probably buy their cookies from the factory for cheap and they double, triple the price. And so the capital gains are what they make, that little extra off what they purchased from the factory, right? Yeah.
Exactly, which is what a lot of consumers, you think about it, it's what's the upcharge. You think about it a lot with buying cars, with buying anything from stores. What are they going to charge? I had to pay this much, but what am I going to put to my consumers? That's, looking at the profit part, but the capital gains, it's when you sell something for more than you paid for it. So if we bought a stock in, let's go all the way back to Cam's disc golf company.
Mm-hmm.
We bought stock in that. We paid, $1 a share. And then now it's really booming. It's at $2 a share.
Boy.
Well, we doubled our money very much.
Hey, we doubled our money. That's great.
Absolutely. So capital gains, when you think of what capital gains are, they generally apply to things like investments, the gain you make on investments. Real estate is a big one.
Yeah.
Businesses, how many times have you known somebody who started a business basically with nothing but the shirt on their back, and now it's a massive, booming, multi-million-dollar business?
Yeah.
If he were to sell that business, he's going to have a lot of capital gains.
Yep.
And then other appreciated assets. So you could experience capital gains on collectibles like art, anything like that. But it is a big phrase that we throw around a lot.
Fun little one that people talk about is like Pappy Van Winkle. It was not that big of a deal. It became scarce, but Daniel's grandfather had a bottle that he paid like $20 for it. And then you could easily have gone and sold it for thousands upon thousands of dollars. So that's where a lot of that appreciation and things can come with some assets that you may not expect.
But again, if you take that bottle of Pappy and do what you should do with it, which is drink it, then you're not ever going to pay any capital gain tax because you never actually realized any capital gain, because you only realize capital gain and you only have to pay tax on your capital gain when you sell and actually, quote unquote, realize the gain.
It's considered unrealized. So this is funny. I remember when I was learning unrealized and realized gains for a lot of our licensing tests, I said something and David looked at me like I was crazy. So it may fall flat again here. But capital gain, okay, I bought Cam's stock and I purchased it, a total of it for $1,000, and now it's worth $2,000. I have $1,000 capital gain, but it's unrealized. I'm not recognizing it. It's not realized. I'm not declaring that I'm doing that. But the second I decide to sell, I've realized that I've got to deal with that there's $1,000 gain that I'm now going to be taxed on. Now, you're not taxed $1,000.
No.
You are taxed on the gain of $1,000 at the appropriate tax bracket.
Right. And the tax bracket can be determined by a couple of different things. First of all, how much capital gain you experience, but also how you are taxed on your capital gain depends on whether it is long-term capital gain or short-term capital gain. So let's talk about that.
Let's talk about short-term and long-term, because that will make a huge difference whenever someone says, I've got all these different positions and I need to sell something. The first thing you're going to look at is gain and loss versus, and then long-term and short-term, and really determine the best option.
Yeah, if you were to talk to your advisor, if you were to come to talk to David or Katie and ask them, I've got these stocks that, they've appreciated in value by thousands and thousands of dollars.
I've made all this money.
I need to sell it. How do I sell it? Which ones do I sell? Which ones should I keep? The first thing David and Katie are going to do is they're going to look at the stocks and go, well, you've owned this stock for 10 years. You've only owned this stock for 6 months.
Yeah.
So if you've got thousands of dollars of gain, both have increased by thousands of dollars in value, and you want to sell some, but you want to be careful about what taxes you're going to pay, you're going to want to go for the long term over the short term. Anything that you have owned for a year or less is short term. So if you sell something after you've only had it for 6 months, say, and you realize some sort of gain from your sale, then that is a short-term gain, a short-term capital gain.
And so why does that matter? It's not that, you didn't hold on to it for long, but it's that you are going to be taxed. If it is short-term, you're going to be taxed at ordinary income. Okay, ordinary. What's the big deal with that? Why does this matter? It's because it can be significantly higher depending on your income, and it often catches people off guard. Versus if you hold it long-term, then this is one that's been held for more than a year, typically taxed at a lower rate than the ordinary income. So time can reduce the tax impact. Long-term investing is often more tax efficient.
Yes.
So this is a lot of times why you may hear somebody saying, you're not trying to do the get rich quick scheme because it's great. Okay, I want to buy this stock and then it's skyrocketed. Now I want to sell. How long has it been that you've held that? Because then, you could have gotten rich quick and had this big gain and sell, but then how much of it are you sending back out the door for taxes? Which is why it's important to always invest smartly and probably look at those things of what are you going to hold for a long term? What are you going to have for at least a year?
So we can't say to you on this podcast what exactly the tax percentage is that you would pay on a short-term capital gain, because obviously that depends on what your income is and what tax bracket you are in. Long-term capital gain taxes are charged at either 15% or 20%, depending on how much long-term capital gain you have experienced. So for a lot of people, just by saying 15 to 20%, depending on the capital gains you made, people are going, well, wow, that is less than I would pay for ordinary income because I'm in the 24% tax bracket. So that is what we're talking about. And that is the difference that we're talking about when we talk about long-term versus short-term. Now, I guess I should also say, or one of us should also say, you kind of alluded to it, but if you're a tactical investor and you're trying to play the market and get out when a stock has peaked and so forth, then you may not be concerned with long-term versus short-term. Because if it peaks, absolutely know for sure that it's peaked and it's going to start dropping and you want to earn as much as you can at its peak, then you go ahead and sell. You're not worried about, I've only owned this for a month. So
it's what's your objectives. And that's where the thing is obviously we want to make sure a client is taking investments and having appropriate allocations, appropriate balance, but they were also very much aware of the tax implications. And that's why when somebody will call me and say, Katie, life happens, we need, $5,000 to cut a tree down. I'm going to look at all the different possible options, but look at their tax impact that it's going to be, because in that situation, yes, they may call me and say, just pull it from blah, 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 which I'm going to look at where they recommend, but then I'm going to look at all the other options to make sure as a whole, where is the best place to pull from. Yeah. And so how long you hold an investment can matter just as much as how well it performs. So that is another thing to think about it, because, we talk about capital gains, and then there's the flip side of that, obviously, is the capital losses as well.
Yeah, sure.
So timing considered when capital gains matter most. So the holding period, the 1 year line, the difference between short-term and long-term capital gains comes down to a single day. Selling before the 1 year mark can mean paying ordinary income taxes. Waiting until after can result into the lower tax brackets. We already covered that part. The calendar year matters. Capital gains are reported in the year the asset is sold. Selling in December versus January can shift taxes into different years. I can't tell you the number of times that we've really looked at that. Number one, from a couple of different perspectives. December, looking at, okay, what have we had to sell this year? What is the gain we're looking at? What is the loss we're looking at? What do we need to do for this point? Or, hey, can we wait? We've sold a lot this year. You got a lot of gains that are going to be impacting you. Can we wait and sell in January? So timing, if you get nothing else from this episode, timing is so important. And you're going to go, well, wait, Katie, I thought you told us that it's not about timing the market. It's about the time involved in the market. Yes, that's still a statement that we stand by. But it is also appropriate of timing when to sell, when to do different things like this because of the impact from it, of the tax impact from the different aspects of that, the ripple effect that comes from this. So for example, if you came to me and said, Katie, I really want to, get this whole new glass case set up for my disc.
Yeah.
I'm like disc golf disc.
Like a nice display case.
Nice display case. And I want to do this. And then I want to like start up a whole new thing. I'm going to need some money from this. And I'm like, and you come to me in December. I'm like, okay, Cam, you already spent a lot of money this year. Like, why don't we wait till next? And I would be doing that because I'm trying to break up the tax burden between 2 years. But if it's one of those that it really didn't matter, you were going to stay in the same tax bracket, whether it was this year or next year, I'd be like, you know what? Let's go ahead and do it now. Let's get that glass case for you. So that is why, again, it depends. Every situation is unique. And that's why when you're determining when to sell something, you've got to not just look at, oh, my stock has gained by this, I can sell this. Take a half a second back to say, what is going to be my tax implications? Am I selling it at the right time? Has it been a year? Has it not been a year? Am I close to the end of the year? Should I wait till next year? Like, what are the different aspects of that? The income level at the times of sale. Capital gains are influenced by overall income. A gain realized in a high income year may be taxed differently than a low income year. Like, as much as everyone groans and hates taxes, I mean, I'm one of those. I hate talking about the tax implications, but that's what it is. Our entire lives are surrounded by that. How much are you making this year? How is that going to impact this? How is that going to impact that? And so it is frustrating when someone goes, hey, I need to pull some money out. It's like, well, have you thought about XYZ? Let's figure this out. So it's not just a simple, sure, let's just pull it from here. We really are truly calculating and looking at all the ins and outs of it.
When I was just an investor and wasn't actually in the financial advisory field, it never really occurred to me. I never really thought about it a lot if I called up my advisor at the time and said, hey, I need this much money. It didn't occur to me that they were looking at what stocks I was holding and they were selling off, what they thought would be the best thing to sell for tax implications, for realizing the most gain or, realizing a loss if that was possible. All of those things were going into their consideration of what they should sell before they just stroked me a check for however much money I said I needed. That kind of thing just didn't occur to me. So if it didn't occur to you either, but that is the kind of thing that our advisors here are considering when they're looking at what they need to sell to generate some money for you.
Life transitions. Certain life events can change how capital gains affect you. Retirement, job changes, selling of a business, receiving an inheritance, downsizing or selling real estate. So these are all things that are kind of out of the norm. Now, obviously, I would think retirement would make sense. The income is stopping, but that could be a year that we have less income this year. Do we need to start diversifying? Or that word?
Oh, yeah.
Do we need to start diversifying because you're holding on to this stock that has this huge gain and it's been not a smart decision to sell out? That's another thing that, Court, you and I have been working with a lot lately. Some people will find themselves in positions where they own a particular security that has a large capital gain in it. And so again, remember what we said, they are not having to pay anything on that until they recognize that they've got that they're going to realize that capital gain.
Right. But if their stock that they have this massive capital gain in makes up 50% of their portfolio, the desire to diversify because
you're weighted too heavy in that one position.
Yeah.
And so we go, well, what are we going to do? I don't want to recognize, $500,000 a gain. Well, there's baby steps you can do.
Yeah.
If that $5,000 of gain is over 100 shares, we can start selling a couple of shares a year.
Yeah.
Or years like a job change or retirement or something like that where the income is less. Why don't we sell a little bit more? Like, what can we do there? So it truly is, you are constantly playing the tax game and the tax strategy.
Or if you're not playing it, then somebody's playing it for you.
Yeah, exactly. So you should be able to be very well aware and well versed on how it's going to impact you by looking at everything, which is why it's important to understand what tax bracket you're in, what your income sources are going to be. So when you can make these decisions, your advisors can really help recommend what's best for you. So how does capital gains fit into a bigger picture? It is tax decisions along the way. So when you're needing cash needs, risk management, long-term goals. Sometimes realizing gain is necessary and appropriate. Like we just said with that, it can be appropriate for some if they are too heavily weighted. Now, one of the things that I'm seeing a lot, and this is kind of going off, but it goes into this with dealing with capital gains. There is becoming a trend across a lot of companies. We're going away from pension plans. Pension plans really are not happening anymore, but we're starting to have a trend of companies that are paying their employees stock. And, it may be like, oh, you've got a 401k and you can invest in the stock of our company within the 401k plan, or we award stock to our higher ups, things like that. But people can get way too heavily weighted in their paychecks coming from that company.
Yeah.
Their 401k is invested in that stock. They're getting awarded stock. And then when you sit down and look at their balance sheet, you go, okay, well, you've got, these positions over here. And then, like 60% of what you have is all relying on this one company. That's scary. Mm-hmm. That is really, that's a very risky situation. And so that is awareness, number one, of finding out if you're in that impact and then putting together a plan. And so a lot of times it's not an easy, hey, we'll sell in December instead of January. It may be a 5 or 10 year plan to really get you into a position that's a little bit more comfortable.
Yeah.
Again, everybody is unique. This episode is really just to explain what is capital gain. So when you hear that, you understand that. Now, we touched a lot more on security aspect of it. Mm-hmm. But let's go back and let's talk about the real estate aspect of capital gain.
That's fair. Obviously, one of the big things that you will find yourself dealing with if you are a family who has lived in the same house for a long time. Let's say you bought your house back in 1980 something, and it's now 2026. So you've owned your house for 40 years. Yeah. That puppy has gone up in value while you've been living there. And if you decide that you, at some point in your life, you and your spouse are now empty nesters, and so you want to downsize, or you've always wanted a house with a movie theater inside, so you want to upsize, whatever your reason for selling your house is, your 20 years of the value growing of that property. Let's say in 1980, you bought it for $114,000, and now it's worth $600,000. That's almost $500,000 of capital gain that you're going to realize. Now, there is, as far as taxes are concerned,
what am I going to do? $500,000? Explain this to me.
Now, if you just take that money and cash out and say "see ya," then obviously you're gonna owe capital gains taxes on $500,000 of long-term capital gain. But there are rules in place where a couple can roll their money over into a new house because presumably you're going to be buying something new to live in, to continue to live, and so you can do that and avoid paying capital gains tax.
And there's exemptions.
There is an exemption as well.
Well, no, technically exclusion, not an exemption. So homeowners can exclude up to $250,000 or $500,000 for a married couple filing jointly of your capital gains. So, Court, that house you mentioned, if it's a married couple, they can exclude that entire $500,000 capital gain on the sale of that home from their income taxes, but they had to have resided in that home for at least the last 2 years of the 5 years preceding the sale, right? So had to have owned the home for the 5 years, had to have been staying in it at least 2 of the 5 years prior to the sale. Mm-hmm. This exclusion is generally allowed only once every 2 years. Okay, so 2 and 2, 5 years prior to the sale, you had to have been staying there at least 2 of the 5 years, and you can do this every 2 years. So it's got to pass those tests. It's got to be your main home where you live most of the time, because there are people that have rentals, things like that. You cannot have used this exclusion for another home sale in the prior 2 years of this period. The partial exclusions, if you fail the test due to a change in employment, health, or unforeseen circumstances, you may still qualify for a partial exclusion. So this is important. If you sell your home for a loss, you cannot deduct the loss from your income taxes. And then what Court was mentioning about a lot of people may take their gains and roll it into another property, that is called a 1031 exchange. Now, by the time somebody actually tells you that, like, you're really getting into the weeds of stuff, but that is something that is a way for, if there was a gain of $600,000 and you had $100,000 that we're having to deal with, because again, that $500,000 would be excluded. That $100,000 could then be used to purchase another home, and you must hold that then home for at least 5 years. There also, at least right now, is a surviving spouse where some survivor spouses may be eligible for the full $500,000 exclusion. And you think about that. The couple who's been together had this house for a long time, spouse passes away. That could be something to be faced. Disclaimer about all of this. Tax laws change, policies change. So it's best practice to touch base with CPA, touch base with your advisor to make sure it's still $250 and $500. It's still 5 years. It's still 2 years, that all of that still stands the same.
Okay. And one thing that I should clarify, Katie mentioned 1031 exchanges. Generally, when you're talking about 1031 exchanges, you're talking about investment property. So that would be if you own multiple properties and let's say you rent them out and you want to do a 1031 exchange. You sell one rental property to buy another rental property of like kind. That would be a 1031 exchange, and that's how you can avoid capital gains taxes on that kind of property. The 1031 exchange does not apply to your personal residence. That is when the $250,000 and $500,000 what's the correct word? Exclusion. The $250,000 and $500,000 exclusions come into play on your personal residence. And if you were to sell your house and profit by $600,000, then that $100,000 difference between the $500,000 exclusion and the $600,000 that you actually profited, you're going to pay taxes on that $100,000. So just wanted to make sure that we were perfectly clear on that.
Perfectly clear.
Also, I feel like because I'm a lawyer and because I deal with this a lot when I'm doing estate planning, and because I know David is probably thinking the same thing, if he's listening to this, we should at least touch on
step up in basis.
Step up in basis.
Yes.
Yeah. So there's been a lot of talk recently. There are people in Congress that might want to do away with the step up in basis. And I am not a fan of that idea because I very much like the idea of the step up in basis. But all of these different capital gain scenarios that we've been talking about, whether you have securities investments or if you've got a house that's significantly increased in value over the years and you had a very, very low basis to begin with, it doesn't matter. When you pass away, the recipient of that property, security, real estate, whatever it is, they receive a step up in basis, which means that when they sell your house, if they sell your house, it doesn't matter what you paid for it. What matters is what was the value of the house at the time of your death. So if I die and I own a house that is worth $1 million, but I only paid $100,000, when my children inherit that house and they sell it for $1 million, they have no capital gain. There's zero capital gains because the basis of my house, when they sell it after I die, the basis is going to be what was the value when I died. And if it was $1 million and they sell it for $1 million, then boom, you're done. Bob's your uncle. Have a nice day.
You're done.
Continuing to prove that there's always little quirks here and there.
There's little extras. There's always something we didn't catch.
So, yes, it could be the value of the position, the house, whatever, on that day that they die, or it could be 6 months after death.
You can elect to use the value 6 months after death.
So again, this is why it's important to have partners that can really help look at all the ins and outs of this. But to reiterate what Court brought up is if you've got, grandma who's NT stock or something that she wants to gift to you, it might be a better option for her to just wait and you inherit it and she can write it down in her legal documents that it's going to go to you. Because then you'll get these step up in basis and you will not have that massive capital gain to be dealing with.
Yes. Very, very good point.
So there's, again, a lot of ins and outs with capital gains, lots to consider about how it impacts you personally based on your income brackets, which capital gain tax brackets you would be in, based on what policies are out there right now, because we're recording this in 2026. Who knows what it could be next year, the next year, 10 years from now. But it's just great for you to understand what is a capital gain, how does it impact you, and knowing the difference between when you pull your portfolio up and you see a gain, that's not impacting you right now. That is future problems to be dealing with, and that's something to then strategize appropriately.
Sorry, we're still close enough to the beginning of the year that reminds me of, in December when I was thinking to myself, that's a 2026 court problem, not a 2025 court problem.
That's future problems to handle.
Yes. No, I think that was, I think.
Cam, do you think you understand it?
Totally, 100%. I got it. Capital gains. I'm ready to hit the gym to get some gains.
Let's get it.
Well, there's the closing bell. Ladies and gentlemen, you've made it to the end of yet another episode of the BullCast podcast, episode 299 to be precise. If you liked what you heard and you'd like to hear more, please feel free to go to your favorite subscription service and sign up to have our podcast delivered directly to your device every single Thursday at noon. If you'd like to find out more about Cortland, Katie, Cameron, or Nicole, please feel free to go to our website. That website is bullcastpodcast.com. We've got pictures up there, we've got our bios, and we've got a place where you can drop a comment or suggest a topic you'd like to hear us talk more about. But I mentioned pictures. We do have an Instagram handle where you can see pictures, and that handle is at BullCast Podcast. We also have an X handle, which is also at BullCast Podcast. And rounding out the social media, we do have a Facebook page. That Facebook page is BullCast the Podcast. So check us out there. But as I do in every episode, let me remind you all that me, Katie, Cameron, Nicole, we all work at a place called Pickler Wealth Advisors. And if you'd like to find out more about us, find out more about what we do, find out about what we could do for you, find out about our amazing team, or find out about our boss, David Pickler, please feel free to go to that website. That website is picklerwealthadvisors.com.
That's advisors with an O.
Not an E.
Ladies and gentlemen, we've given you everything you need to go out to the gym and get some gains, or just understand
Learn about your capital gain.
Yeah.
So for now, I'm Court.
Katie.
I'm Cam.
And we're done.